Welcome. This is Howard Sorkin, DePaul University, the case study class, and I'm giving an overview of Chapter 7 on disability income from the textbook. Disability income planning is probably one of the most underused and under-resourced items in financial planning and by insurance professionals. It's a little more expensive than others, and most people say, well, what do I need it for? But if you think about the fact that all of us, or most of us, have bills that have to get paid, and the bills that have to get paid could be our rent, car payments, student loan payments, put food on the table, take care of our children. If you're single, you still have a lot of those same bills. And most people don't have emergency funds or money that they can fall back on. Some planners say that you should have the longest elimination period available, even 180 days. I disagree, because the goal of disability income planning is to manage risk and to permit you to have a lifestyle with dignity, even if you become disabled. And that's an important thing to remember. And disability income is important because most people don't have an emergency fund. Very few people today have defined benefit pension plans that they can rely on if they become disabled. You can't rely on Social Security because you have to be in a very narrow area in order to qualify. You have to be disabled for a minimum of 5 months to apply. The disability has to anticipate lasting at least a year, be permanent, leave you unable to work, gainfully employed, and or result in your death. And most people don't qualify for that. Most people don't have a lot of sick days, and in many cases they're not allowed to keep their sick days rolling from year to year. It says here that a 42-year-old worker is 4 times more likely to become disabled than to die during his working lifetime. I've always said, and what I was taught was, a 35-year-old who's healthy is 7 times more likely to be disabled for a period of 90 days or more prior to retirement than of dying before retirement. And disability doesn't mean that your bills stop. You can have private policies where you pay for them on your own. You can have policies partially through work, and we're going to discuss the different variances. Again, this is an overview. There's an entire chapter in the textbook on disability income planning. And it says the purpose is to cover loss of income in the event you're sick or disabled. So you want a plan that's going to provide for coverage if you're sick or if you're disabled due to an accident. You don't want either or, you want both. It further says that the coverage will be, the amount of coverage that's available is going to be based upon your health, your age, your sex, your income, because we're going to use a morbidity table. Morbidity table, which means how likely is it you're going to need some kind of medical coverage. Women tend to need have medical coverage where they're going to pay a little bit more on the morbidity side, and they're going to pay less on the mortality or death side. The item here in red I disagree with, where it says that percentage replacements, nearly all policies offer replacements of 70 to 80% of your pre-disability income. From what I've seen in the industry, it's closer to 66%, so I would just be cautious on that. This is just a grid from the 1985, so this is pretty old. And it says that a 40-year-old, the probability of death prior to age 65 is 21%, and it's 48% of being disabled before 65. This is a pretty accurate chart. If anything, I think the disability side has gone higher by percentage, and the death side has probably been lower. You need to understand the difference between short-term and long-term disability. Short-term disability can be anything from 30 days, 6 months, maybe up to a year, and in some cases, some firms might have it up to 2 years, and it might be part of your health insurance plan. Long-term disability is anything longer than a year in most cases, and it's going to go until retirement. Please be aware of the fact that long-term disability is what's really more important, because most people can figure out a way to fend for themselves or have family help them or something for 60 or 90 days, maybe even for 6 months. But not many people will be able to survive 2 or 3 years of being disabled. And I will tell you that the days of corporations allowing workers to bank sick days so they have 100, 150, I don't see that happening too much any longer, even in the government. You're starting to cut that back. Certain terminology you need to understand. What is an elimination period? It says the elimination period or waiting period where no benefits are paid. That means there's no benefits accrued during the elimination period. So if you have a 60-day elimination period and you were disabled on January 1st, you have no benefits accruing, not just being paid, but nothing accrues for 60 days. So you don't start accruing benefits until maybe March 2nd, March 3rd, and then each day after that you're getting 1/30th of your monthly benefit. So where it says elimination period may vary from a month or less or longer up to, here it even says a year, most of the plans I see that people get have a 60 or 90-day elimination period. Even though the textbook says go longer, yeah, you can go longer to keep your price down, but then you may not get the benefit and you may run out of actual cash that you need. A 60-day elimination period means you do not get your first check for about 95 days. A 90-day elimination period, you won't get your first check for over 120 days. So whatever that elimination period is in the real world, think about the fact that you're going approximately a month later to get your first check. Some companies will pay it every 2 weeks. Most companies pay it monthly at the end of the period of time. Disability. It can be an illness. It can be an accident. And it could be cognitive, which is Alzheimer's. And don't assume that Alzheimer's only happens to people if they're 60, 70, or 80 years old. Large insurance companies have, in the last several years, admitted that they paid claims on Alzheimer's down to, I think, age 39 and into the mid-40s. And it says only those people with substantial wealth might be able to continue their own lifestyle without some actual income. The purpose of income replacement or disability income insurance is to guarantee that you can stay in your lifestyle, pay your bills. And even though people have, at large companies, they may have the Family Medical Leave Act so they can help care for somebody, they're still not going to provide income for them. And most plans aren't going to provide income if you're caring for a loved one. What is the need? I think the need is very great. And I think even if you have two income families where mom and dad are still working, you still may need to supplement disability income. How can you figure out how much coverage? Well, look at what the needs are of your client. If they're spending all their money, and let's say for simplicity, they're making $5,000 a month. Out of the $5,000, roughly 30% is going to be used for taxes, Uncle FICA taxes, Social Security, income taxes, the state of Illinois taxes, or whatever state taxes you are. So let's just say you net out of $5,000, $3,500. So you'd probably qualify for $3,000 a month of benefit, $100 a day. That should be hopefully taking care of your needs. If mom and dad are both working, you still may need that amount of income because your student loans don't stop just because you become disabled. And I will tell you that I have seen and heard of cases where women in their 20s and 30s have become disabled in childbirth because things have happened. So don't assume that just because you're young you don't need it. I just lost the slide I was on. That's slide 9, that's it. Unlike life insurance, fewer disability calculations will exist, and what you need to figure out is how much cash you have in your reserve account or your emergency fund. What about your number of sick days of work or your vacation days that you can use? So maybe between all of that, you can cover the first 60 or 90 days. And then project how long you need the coverage for. Now, I can only tell you statistics and averages. I don't know the actual cases. But from what I can figure out, most people fully recover within 2 years, better than 90%. But if you're not fully recovered within 2 years, there's about a 90% plus chance that you're not going to recover. If you're in that 10%, that didn't recover in 2 years, there's a good chance you're going to recover within 5 years. But if you don't recover within 5 years, you're probably going to be disabled for the rest of your life. How long do you want to have the benefit for? So you need to be aware of the elimination period and the benefit period. And the benefit period, the longer the benefit period, the more expensive the premium. Is it 2 years, 5 years, all the way to age 65? So pay attention to the elimination period. The longer the elimination period, the lower the premium. Pay attention to the benefit period. The longer the benefit period, the more expensive the premium. It says here, how does this thing work for emergency fund? Most clients don't have an emergency fund. We've talked about that in classes before. Disability says analyze all this, analyze the definition of disability. The definition of disability is crucial that people have to understand what it really means. That's what is going to be paid for. You want a plan that says you are disabled from an illness or an injury which first manifests itself from the date after the date of this policy. That means it's there. If something is going to be eliminated or waived out, you want to know about that in advance, and your client needs to sign off on it. And the company has to sign off on it. You don't, the agent doesn't do that. You have to figure out, are there any pre-existing conditions? A back problem might be waived out. I had people where they had vertebrae that had to be fused. Those would be waived out. Obviously, you don't want something waived out if you have a heart condition, because then your whole circulatory system is waived out. So elimination period, benefit period, the definition of disability is what's important. You want to try to have a definition that's called own occupation that guarantees you coverage if you can't do the important and substantial duties of your occupation as a CPA, as a financial planner, as a cardiac surgeon, as a salesperson. Whatever that is, you want the important duties. You don't want a definition that says the inability to work. And you want to make sure that, if possible, if you're paying for this with after-tax dollars out of your own pocket, or if it's an employee benefit where they're charging you some of the premium, that's a good thing, because then the benefits when received are income tax free. If you set it up properly, benefits received are income tax free if you pay for the benefit with after-tax dollars. And that's good, because if they've already given you a haircut for 30% of your taxes, you don't want a second haircut on the benefits when received. It says if a client is insured through a group plan paid completely by the employer, then 100% of the benefit would be taxed to the employee when received. However, if the employee pays for part of that premium and there's a 1099 or additional compensation charged, then not all of that is taxed, and that's very important that you're aware of how that works. You want to make sure the benefit is not taxed to the employee. Sometimes the premium will be shared, and then you have to find out how that works and let the client talk to their tax advisor, not to you. Although the analysis of the client's current situation is the responsibility of the advisor, it also means that maybe that you need, if you're not an expert in it, talk to the insurance broker that helped put it together. Do not feel that you're there by yourself. Your job is to help with the client with resources. When planning for a client's disability protections, consider other strategies, i.e. self-insuring part of it, having an emergency fund, being able to use sick days, being able to use what kind of policy, what's the best policy. You want to know the difference between non-cancelable, which means the contract cannot be changed, modified, premiums cannot be increased, or guaranteed renewable, where the contract can be modified. That's usually a cheaper plan, but sometimes you need to use the cheaper plan for budget purposes. What can you do? You want to try to purchase what's called an own occupational definition, if possible. That's the most expensive, and that's the best one. That's the inability to engage in your regular occupation, the important, substantial, main duties of your regular occupation with regard to education, training, prior work experience and economic status. That means that if you're trained as a cardiac surgeon and you can't operate anymore because you have arthritis in your hand, or you're trained as a practicing dentist and you have arthritis, you can't handle the equipment, you're disabled even if you can teach at a university. Even if you can write books and give lectures and make more money, you're still classified as disabled. Now, without the term with regard to economic status, that same surgeon teaching at a university is no longer disabled. A modified ONOC says you're going to be insured in your occupation, as I just defined, regarding education, training, work experience, economic status, for the first 2 years or 5 years. Thereafter, you may be insured in an occupation for which you're reasonably suited due to education and training. That would be the situation where the dentist who has arthritis can teach or write or review insurance claims, but could no longer practice because of the arthritis. Yeah, that's just modified. And the split definition is somewhat similar to the modified. It doesn't matter if you're getting an employer purchased or an individual purchased plan, as long as you have the right definitions and you understand the plan. There are some companies that will offer protection just for your mortgage. It says consider that. I would rather have my clients consider 24-hour coverage for everything if they could get it. Do not purchase group or individual coverage and rely on Social Security benefits. That's in my opinion, don't rely on Social Security, and you may need to. Increase the waiting period. The longer the waiting period, the lower the premium. So if it's a budget constraint, you might want the client to consider that 90-day or 180-day period so they have the coverage, but they better understand what it means. You might want to lower the percentage ratio from 66% to 50%. You might want to say we're going to use a guaranteed renewable contract to save 10 or 15% premium. You might want to consider a policy that's going to cover either only partial disability or residual, and please look those terms up so you understand the difference. You might want to make sure that you have coverage available when you need it, which means don't wait. Make sure it's part of the plan. The following slides are additional information. See what they say. This slide, again, is in the book. It talks about the elimination period, the benefit period, the qualification period, which says the period of time the insured must be totally disabled before the residual benefit begins, which usually is about 30 days. So once residual means you received your full benefit for a period of time, and now you're able to go back to work but not full time, so you're going to get a sort of benefit. There's a partial disability benefit which says you're not able to work full time, and if you have at least a 20% loss of income, they're going to give you a benefit for that. The following slides here basically give you different strategies the author of the textbook's talking about regarding long-term and short-term disability. Quite frankly, you can read these on your own. They're going to be on the website. My first belief is do try to get a policy that has inflation protection and provides for the biggest amount of benefit coverage you can get for your budget. If you have to modify the definition to stay within a budget or consider a guaranteed renewable versus non-cancelable, that's what you should do. So this has been the overview of Chapter 7 on disability income. Thank you for listening. Have a good day.